The market's been selling off today for the most part and is now down 231, close to the lows on the Dow. Charlie Gasparino, Bankrate senior economic analyst Mark Hamrick, and James Freeman from the Wall Street Journal, all here in studio. It's one of those days, James, you got a lot swirling around. We've been covering the breaking stories of these suspicious packages, but you also have earnings concerns. You had Boeing on the good side, Texas Instruments maybe on the concerning side. But what do you make of all the cross currents?
Yeah, I think equity traders are people just like the rest of us. They see this stuff on the news. It doesn't make you happy and optimistic. And certainly if it is some precursor to larger violence, that's obviously going to dent the market. But I think as we look at where it is today, probably most of that is that earnings concern. You mentioned Texas Instruments, kind of their somewhat negative outlook kind of weighed on the other tech companies. And I think it's just basically these corporate earnings, which have been so amazing, are still really great, but maybe just not quite as great. And maybe the earnings outlook's not quite as great as expected.
Let me pick that up with you, Charlie, in a moment. And Mark, I'm going to come back and talk about rates in a moment, which are obviously a key issue as well. But on the Texas Instruments report, I went back and looked at the conference call comments. They didn't specifically say the tariffs are a problem for them, but such a supply chain company, when they say that demand is slowing down, you'd have to kind of, I think it would be fair to say, why would demand be slowing down?
And the tariffs are playing a role here. I mean, I will say this. The economy is good right now, very good. Markets price in the future. And right now, there's a debate about the future growth. It's a debate about whether the massive corporate tax cuts and a pretty puny, I would say, individual tax cut will produce enough GDP to sustain the type of earnings we have right now. And I don't know anybody that could disagree with that, because every trader, long and short, bullish, bearish, agrees with that sentiment. Where you come out on that spectrum, and you may come out differently than some other people, or you might, it depends on whether you buy or sell this market. And right now, I look at a glass half full. I just don't think there's enough. Or is it half empty? It's half empty. I'm sorry.
Hold on a second. That changes literally the complete meaning of your next statement.
Right? I'm negative. I think that sorry.
I'm sure this guy.
Every now and then.
Maybe you should hold.
Maybe every now and then I make a mistake.
Positive, negative.
I'm negative on this. And the reason why is because I think net, when you cut corporate taxes this much, the emphasis is not on increasing spending on goods and on employment. It's on doing stock buybacks. And I think if there was one problem with the Trump tax cut, it was a puny income tax cut, and it was a very large corporate income.
All right, Mark, pick up on that.
Yeah, well, we just completed a survey at Bankrate that I think in some ways affirms what you're saying. Only 4 out of 10 Americans said that their personal finances had improved over the past 2 years since the general election.
That probably surprised you.
It was interesting, but, I do get pushback quite a bit from people who say, you guys live in Washington, you guys live in New York, get out across the rest of the country and see what it's like in Kansas, in Niagara Falls, in Appalachia. So, we're living in divisive times. The economy doesn't lift all boats all at once. So we're hoping the expansion continues to lift more boats.
I don't believe that things are great necessarily. Phenomenal in Kansas. I mean,
there are a lot of areas. No, that's his point. That they're not great in other parts of the country. And I would say at the same time there are areas where they are terrific. Some of those are driven by one-offs. Like when I was in Texas in the Permian Basin, it was like a literal boom from the oil boom. And then
in Dallas, go outside of Dallas right now if you want to see boom times. I mean,
exactly.
I was at the Cowboys training center. It's called the Star in Denton, Texas.
You were trying out again?
No, I have a friend who's friends with Jerry Jones. So in that event, by the way, it's an amazing place. There's corporate offices there. There's training facilities, but around it is Boomtown. Toyota, they're building. So there are pockets of real. And we should put Texas has had pro-growth policies for many years. The question is, from a federal level, how good of the bang for the buck are we getting out of this?
So what's the next kind of question, maybe, James, you take this up, that we should be asking? By the way, in the middle of all this, in your newspaper, the president took another shot at the Federal Reserve last night. He did it with Trish Regan when he was on Fox Business. I think last night it was something to the effect of Jay Powell looks happy when he's raising interest rates. But that's kind of in the middle of this whole discussion. So go ahead.
Yeah, I think the Fed is on the right track raising rates when you look at prices. I think the president is right to be concerned given the Fed's history, which has not been stellar. They really have been involved in a lot of financial catastrophes over the years.
Usually on the other end. Not raising rates.
You can find examples both ways. You look back to the 1930s, and it was really about being too restrictive.
Yeah,
so,
but that was different. That was in the face of an asset bubble. But
there's a bad history. Here's the point. But just to get back to this, I think the bullish case is that this was a pro-growth tax cut because it was not designed like a lot of these weird Washington stimulus programs to just put money in people's pockets to get them to spend more. It was focused on long-term growth, and what making that corporate rate competitive with the rest of the world did was it encouraged investment. That's happened.
Really?
That capital expenditure is what gives more productivity. We'll see on the productivity. We know the capital expenditures are up.
Yeah. Now,
in fact, that's almost exactly at the level the White House predicted.
But that's not because of the tax cut. That's
because
there was a write-off on capital expenditures. That was a very smart thing to do.
It's the tax cut that has lifted business spending.
What about the write-off of capital expenditures?
That's a part of it.
That's a big part of it.
The rate part is huge because you changed the incentive to invest in the United States.
The rate part led to massive corporate buybacks. Not saying that's necessarily bad. I'm just telling you that is
along with higher corporate spending. And what that is going to give you is
I think the corporate spending is related to the other thing.
And you're not mentioning wages, by the way.
Yeah, wages are pretty flat.
Go ahead, then mention them.
Yeah.
Take it from there.
Yeah, well, I mean, obviously, that continues to be the unfinished work of this economic expansion. And when we can't break above 3% on average hourly earnings in the monthly employment report, that tells you that people are still asking, show me the money.
Yeah, so corporations are not spending their money on the individuals.
It's so unclear right now whether we're in some sort of a phase that just is 100% normal. We needed to pull back from something if you go up for 9.5 years, or this is the start of something much larger. What's your close your take on that?
I think one thing that the president was talking about that he's right about, and it's why I think maybe you might think this rally is real, is that it's happened unlike the period when President Obama was in office, where you had the Fed being very accommodative, going to zero rates for years and years.
Well, you give me those kind of interest rates, I'll show you.
Right. This has been happening while at the margin, monetary policy is becoming less accommodative.
Do you know that
then we got to run.
Netflix borrowed $2 billion. It was announced they were going to borrow $2 billion to build out more content. Think about that. A money-losing company with cash flow problems can go to the market and borrow $2 billion. Yeah. That's a reason for a rate hike, just so you know. That's
too simplistic.
Yeah.
That's too simplistic.
No, it's not.
When you have a company,
Greenspan did before the mortgage crisis.
That's where the Fed can run into trouble when they make that kind of analysis.
No, it's not. Bursting asset bubbles.
You don't know. We'll know in hindsight. What you do know about Netflix is phenomenal growth in users,
talk to Alan Greenspan,
which is going to attract capital.
Alan Greenspan will tell you that his biggest regret is not raising rates in 2005 and 2004.
You want to break the tie on this, Mark, before we wrap things up?
The Fed needs to have more ammo in the gun belt. And when the next recession arrives, they do not want to be where they are right now. They'll be needing to lower rates. And that's the thing that's speaking in the back of the minds of most FOMC members is, we're not at normal yet, and we need to get back to normal.
I agree with that.
That's true.
These tech earnings are going to be interesting, too, the next couple of nights. Not only tonight, but tomorrow night. Not, as someone told me earlier, not necessarily what the companies report, but how the stocks react, because that Netflix thing the other week was a great report. And all of a sudden, the next day, it's giving back all the gains. But anyway, thanks to all three of you.